Okay, welcome everyone. Good afternoon, ladies and gentlemen. I hope you are in these unprecedented times. My name is Joseph from All 100 Conferences. For people who are not familiar with us, we are a private equity and venture capital platform, already 5 years on the market, connecting private equity professionals all over Europe. For more information, you can have a look at our website, 100conferences.com. I would like to welcome you all at our first session of the webinar series today with the topic COVID-19 and the private equity market. Few technical informations for the start. We recommend to use the Chrome browser to get the best experience of the webinar. Firefox and Opera should work as well. I would like you to get interactive. You can see on the right side of the window chat, questions, and polls. So do not hesitate to get interactive with the panel. And in the email which you will receive after the webinar, you can also have a look on the presentation from Kraken. You can already save the dates for the upcoming 2 webinars. The first one will be on 27th of May and another one on 18th of June. I would like to thank the partners of the webinar, the main partner, Silverfern Group, media partners, Kraken, IPE, ILPA, CE Legal Matters, and all other partners and associations. Without further ado, I would like to introduce the moderator of today's webinar, Managing Director at the Silverfern Group, Robert Spittler. Robert, floor is yours.
Thank you very much. Very happy to be here today. Great to see so many attendees joining and doing my best here to be a good moderator with a great panel, and can assure you we have a very competent panel today. And I will start directly with introducing you to the panel, starting ladies first. Aoifinn Devitt from Federated Hermes. She's head of investment at Hermes Fund Management Ireland. She oversees the UCITS funds and AIFS. She also works as an independent advisor for 4 pension funds and provides strategic advice. Prior to her role in Federated Hermes, she was founder of Clontarf Capital, hope I pronounced that correctly, and an alternative asset advisory and research firm. And prior to that, she was CIO at a $2.6 billion Chicago police pension fund. So her core competency is really to give objective advice in the area of alternative investments. Panelists I do not see here yet due to technical problems, but who wanted to join from the European Investment Fund was Joaquín Ruiz. He is responsible for the secondary activities of the AIF, European Investment Fund, and has 15 years of experience in the field of private equity and alternative assets, currently overseeing the secondaries program, and prior to that being in a role in primary investments, fund investments, and European mid-market buyouts and mezzanine funds. Then coming to the GP side, Peter Garvey from Melior Equity Partners, founder and partner. Melior is a private equity firm focusing on the Irish market that spun out of Carlyle Group and is currently also managing a fund dedicated to the Irish market by the Carlyle Group. He has previously worked with Goldman Sachs and McKinsey. Melior is targeting the lower mid-market with equity checks between 10 and 20 million euros. And then we have Mark Corbidge, Sun European Partners. He is leading the deal team in Europe. His prior role was at TPG Capital Partners, we all know, CPPIB, and Doughty Hanson. So 3 large firms in the industry, and he's a leader of mid-market transaction. Sun is specialized at accelerating growth through operational excellence. He invests out of fund number 7, a 2.3 billion global US and European focused buyout fund that writes equity checks somewhere in the range between 50 and 300 million with the help of co-investing LPs. And before going into the panel, I want to give some housekeeping, get out some housekeeping advice. The agenda will be that we will start with a short introduction of Preqin, roughly 10 minutes, then we will go into the panel discussion, and then we will have 20 minutes of an open Q&A session. And now, speaking of Preqin, Kamal Simpson, he is Vice President of Private Capital Group. He is directing Preqin intelligence of the EMEA fund manager community, and he ensures the flow of quality data in between the industry participants. And we all know Preqin for the quarterly reports in the database. So please, Kamal, get on stage and share your latest update based on research your firm has done. So please, Joseph, do your magic, and yeah.
Okay, thanks for the introduction, Robert. On the agenda for today, I'll first highlight the key themes and trends that came up in our global reports. I'll then move on to the question at the forefront of everyone's mind. What will be the impact of alternatives, or what will be the impact of COVID-19 on the alternative asset industry? This will include some preliminary insight on how the alternatives industry is reacting to the effects of COVID-19 and what is likely to come in the rest of 2020 and beyond. So let's get started then. What does the alternative market look like as we enter Q2 2020? Well, COVID-19 has clearly had a sudden and significant effect on the global economic activity. However, prior to the outbreak, the alternatives market had been experiencing an unprecedented period of growth. Preqin is now tracking over 12,000 institutional investors actively investing in alternatives who have flocked to the market in search of portfolio diversification and higher yields. This is up from 3,000 investors a decade ago. And as a result, global assets under management has surged, especially in recent years, to 10.3 trillion as of June 2019. That represents a rise of more than 3 times since the global financial crisis. Private capital has been the primary driver behind this growth, with assets under management now standing at 6.7 trillion. Both private debt and real estate sit just under the $1 trillion mark, and private equity has surpassed 4 trillion in AUM, overtaking hedge funds as the single largest alternative asset class. The tremendous growth wouldn't be possible without strong fundraising backing it, and that has certainly been true this decade. The last 3 years have seen private equity fundraising consistently surpass the 600 billion mark. However, there has been a notable decline in the number of funds closing in the last 2 full fundraising years. Comparing 2017 with 2019 shows 1,000 less fund closings, supporting the theme of capital consolidation within the industry as investors target placing larger amounts of capital with bigger managers that have a proven track record. So, what has fueled this growth in alternatives? Well, put simply, investor demand. As you can see on the left, portfolio diversification is a key driver across every asset class as investors continue to spread their exposure across uncorrelated markets in search of yield. In addition, fund performance and the ability to deliver risk-adjusted returns keeps investors coming back for more. On the right here, you can see that private capital funds of vintages 2011 to 2016 have consistently posted returns in the 8 to 15% range, with private equity being particularly successful. The median net IRR for private equity funds of vintages 2007 to 2016 stand at 14.9%, cementing its place as the largest alternative asset class with 4.1 trillion in AUM and 1.4 trillion in dry powder. And investors are generally satisfied with the performance they are seeing. As you can see on the left here, 80% of investors we surveyed in November 2019 told us performance had either met or exceeded their expectations during the year across most asset classes. However, a lot has clearly changed in the world since November 2019, and while the vast majority of investors expected this strong performance to continue into 2020, it seems inevitable that these expectations would need to be revised in a post-COVID-19 world. And we will dive into that in a little more detail in the next section. However, before we do that, it is still worth highlighting the level of confidence investors had in alternative assets going into 2020. Pretty much across the board, over 80% of investors were planning to invest either the same amount or more capital in the year ahead v 2019, yet again demonstrating the faith investors have in alternatives to keep delivering against portfolio expectations. And it is due to that confidence that Preqin made a conservative prediction in our Future of Alternatives report in 2018 that industry assets under management would reach 14 trillion by 2023. Now, we will monitor this estimate closely in light of changing market conditions and revise if we need to, but the fact remains that the industry is already outpacing that projected growth rate and running approximately 12 months ahead of schedule. Yes, there are challenges ahead, but the longer-term growth potential across alternatives very much remains. So that is how the alternatives market stood prior to the outbreak of COVID-19. However, the world clearly feels like a very different place now compared to a few weeks ago. While it's very early days in the crisis, Preqin has been speaking with hundreds of investors and fund managers to get an early view into what is happening across the market and how the outlook may have changed. And we'll take a look at some of this data now. Looking at Q1 fundraising results, there are clear signs of a contraction across private capital. Global fundraising was down 30% in Q1 compared with Q4. It is the lowest quarter since Q1 2018 and the fewest number of funds to reach a final close for 7 years. All regions and the majority of strategies were impacted, although not surprisingly, being the first region impacted by the virus, Asia was hit the worst, followed by Europe, then North America. Fundraising across Asia was down 66% in Q1 due to having restrictions in place much earlier. And while fundraising in Europe was also down 48%, the COVID-19 situation remains in a much earlier phase, both here and in North America. So Q2 is likely to be even more challenging as the pandemic continues to move west. Venture capital fundraising saw a 44% increase in Q1 compared with Q4, mainly due to some $1 billion plus fund closures that took place early in the quarter focused on North America. Deal activity has also taken a hit. Although global buyout deal flow in Q1 was largely in line with previous quarters and deal volumes actually even improved slightly for Europe and North America, Asia saw an 80% fall in aggregate deal value. That represents the worst quarter for Asian deals in 11 years. Similar to the fundraising market, both investors and fund managers will continue to take stock in these early days. Deals are likely to be postponed as we wait to see how the market reacts. Investors have also become more wary. I mentioned earlier that LPs came into 2020 full of confidence and planning to put increasing levels of capital to work across alternatives this year. However, this is a sneak peek at an investor survey we ran a couple of weeks ago in order to gauge their early reactions to COVID-19, and it is clear that many have revised those plans. As you can see here, 60% of investors surveyed will now decrease the planned amount of capital they will commit to new funds over the course of 2020, while 59% plan to reduce the total number of commitments they make. We also asked fund managers about how their operations have been impacted. Unsurprisingly, the main areas of impact have been the ability to fundraise from investors, deal origination, and the restrictions placed on portfolio company operations. However, some areas have been impacted less, and it is encouraging to see GPs doubling down on their IRR with existing investors as they seek to help their LPs navigate through the disruption. In terms of when GPs expect operations to return to pre-COVID status, 74% believe this will happen within 12 months, including 40% who think it will happen within 6 months. However, a quarter think a recovery will take much longer. We have also been working with our partners at risk management firm FRG to create a forecasting model that analyzes the impact of a recession on capital calls, distributions, and net cash flows. I appreciate this chart is a little busy, but it effectively compares a pandemic scenario against baseline numbers for 2017 to 2019 vintage funds. We focused our analysis on these vintages because they account for 72% of the callable capital currently available across the private capital industry. The model suggests GPs will respond to COVID-19 by reducing capital calls and distributions in H1 2020, waiting for valuations to fall and some greater economic certainty. This should be followed by a spike in capital calls later in 2021. In turn, deal volumes will rebound as managers look to take advantage of asset prices. We have also been looking at buyout fund performance and what might happen to funds of different vintages as a result of COVID-19. The baseline scenario here assumes asset valuations remain high and suggests buyout funds of a 2018 and 2019 vintage would have generated lower IRRs than those of 2012 to 2017. However, in the pandemic scenario, 2018 and 2019 vintages are now more likely to outperform, given dry powder is going to be deployed into assets that are better priced, albeit with a greater variation in returns when compared to the baseline. In which case, investors should now expect more muted returns from 2012 to 2017 vintage funds due to the challenging economic conditions created by COVID-19 that will almost certainly impact exit valuations and timelines. So, in summary, the alternatives industry has been going through a period of extremely strong growth. Assets under management stand at 10.3 trillion. We are coming off the back of the third consecutive 1 trillion plus fundraising year in private capital, and performance has been largely meeting and exceeding investor expectations. However, while many were forecasting a market correction sometime soon, few would have predicted such a sharp and sudden end to the bull run as brought about by COVID-19. And as a result, 2020 looks set to be a challenging year as both investors and fund managers try to navigate the difficult times ahead. However, to finish on a positive note, investors are certainly planning to stick with the program. While investors are lowering their immediate fund commitment plans due to COVID-19, they retain longer-term confidence in the alternative asset classes. As you can see here, while GPs are admittedly a little more varied in their views, 92% of the investors we surveyed a couple of weeks ago will continue to invest either the same amount or more capital in alternatives beyond 2020. Why is that? Well, the performance of the asset class speaks for itself. Private capital has consistently outperformed public markets over the years. It has proven to be better at preserving capital, and it continues to offer investors the diversification benefits they so badly need. Hopefully this has been interesting and has set the scene nicely. If anyone has any questions about the deck, my details are on screen now, and I'll be happy to respond to any questions you might have. Feel free to download the presentation if you wish to do so, and I will now hand back to Robert to begin the panel discussion. Thank you.
So, can you hear me? Joaquín, thanks. Great to see that technology did its miracle right on time. So, thank you for joining our panel. So, for those who haven't noticed, our speaker from the European Investment Fund just joined and had a little difficulty getting a login. So let's start this discussion. Thank you, Kamal, for this great data insight, and we will touch on a couple of points you brought up here. I've seen a couple of questions in the chat section about if this presentation will be shared, and what I read is yes, we will share this presentation, and contacts were just given on the screen, and I think we will do a follow-up email and share all the necessary contacts to get a copy of that. And yeah, let's go directly into it. And the way we would like to organize it is to go a little bit in sequence. COVID-19, obviously a highly discussed topic. And I want to start the discussion with a question: how did your firm react to the COVID impact, and what were the first things you and your team did? And ladies first, Aoifinn, how did you and your team react when you saw the developments coming and the news coming, and what happened on your side being an LP and an advisor to the pension community?
Yeah, the first thing was a fairly quick shift to working from home, and I think I'm among many that have found this extremely surprising, just how smooth that has been. It really has been almost without a glitch, and that's been fantastic to see. The other thing, I had one of the last meetings I had before we all went into lockdown was with one of my local authority clients, and we did still do that in person. We all sat further apart. It was quite frankly quite a surreal moment, as we all knew that lockdown was coming, and there was also a sense of trepidation as to what that was going to mean for the portfolio. And it was just one of the most surreal meetings I've been at. I'd say how our team is coping. We're doing a lot of connection on a daily basis by Zoom. There is certainly a bit of Zoom fatigue going on, I'd say, at times. I've also found that channeling a lot of efforts into writing a lot of content, a lot of very proactive client outreach has been great to give a sense of purpose. And I found for me personally that having a very strong sense of purpose in the current time helps to keep me grounded.
Great, thank you. Maybe to stay on the LP side, Joaquín, what happened at the European Investment Fund when you saw it coming with a really kind of European context, and we have shared in the introduction that you are one of the most active LPs in Europe with a broad portfolio, and how was the experience in the European Investment Fund, and what was the reaction on your side? What happened when the pandemic came?
Thanks. So I mean, the first focus obviously has been on employee safety. We've been very rapidly sent back homes, and I mean, I have to say that I mean, for the last 7 weeks we've been working. I wouldn't say at 100% if we were comparing this to before COVID-19, but it's certainly an 80+, if not 90 of efficiency. To adapt our schedules. We all have families. Some of us have little children, so it's not that easy. But at the end of the day, I think it's working pretty well. On the portfolio, as you can imagine, on both sides, we have had a lot of GPs proactively reaching out to the LP community, so reaching out to EIF in order to organize update calls, and we ourselves we have done exactly the same thing. So I mean, I think in terms of portfolio coverage, we may have reached out to practically all LPs, all funds in the portfolio.
Coming to the GP side, Peter, maybe you want to start. How was it on your side with your team when COVID started? What were the first things you were doing, and what was your initial reaction?
Yeah, so similar to the other speakers, Robert, the first priority was obviously our team and making sure that they were set up to work from home remotely and safely. Having done that, I think we switched gears very quickly to the portfolio. And I think in early February, we started reaching out to portfolio companies, surveying them to try and understand how prepared they were. And we collected lots of best practice. We shared that amongst our portfolio company management teams. Simple things like, how are they going to implement working from home? How are they going to safely protect employees that have to work on site? Talking to them about inventories that maybe were reliant on supply chains that might be exposed. And then clearly communication is a key element, because I mentioned that already. Making sure that our management teams were communicating with their teams, their customers, about what was going on. Then we switched gears into scenario planning, looking at the business plans, what we thought might happen, running lots of downside scenarios, liaising with lenders where that was required to make sure they understood the actions that were being taken and some of the situations the companies are in. Cash flow and liquidity has been a key area of focus for us. All our companies have drawn down revolvers or working capital facilities. And clearly for us, it's all about being on top of the portfolio companies. So holding regular conversations with the portfolio companies. I think once we got our arms around the portfolio companies, then it switched to communicating with our investors and making sure they understood where we were. And it's very important, I think, to communicate up and down and make sure that everyone is kept informed. People want information. This is uncharted territory, and the more information I think you can provide, the better.
Great, good to hear. Good to hear that the industry is obviously pretty good at switching gears from a physical meeting to a completely digitized world. And Mark, you're working for a US European firm. How did you? What happened on your side? Or anything you want to add with a specific context of you being active on both sides of the pond?
Yeah, sure, happy to. I mean, again, just making the obvious point about employee safety, both at our company and at the portfolio companies, was the immediate priority. And then, as Peter was just saying, we sort of battened down the hatches, went in search of maximum liquidity. So as with many private equity funds, we drew entirely on our RCFs to make sure businesses had that breathing space. We moved to furlough workers pretty much immediately and started to take full advantage of any financings that were made available from the individual jurisdictions in which the portfolio is. So whether that's the UK government, whether that's the French government through BPI, the Austrians, et cetera, et cetera. So really analyzing where we could go and making sure on the communication front that each and every one of our CEOs and CFOs were liaising fully to spread that information across the entire portfolio as to what we were experiencing. So if a UK company CFO managed to speak with HMRC and find out about the job retention scheme, we'd organize a Zoom, dare I say, between the other CEOs of UK portfolio companies, or for that matter, those with subsidiaries in the UK, to make sure they were fully apprised of the latest developments. And so we've really been, I guess, in bunker mode for a sustained period of time now, and we're just about getting through phase one and into phase two. That's really how that's happened from our perspective. I'd just say finally that I did chuckle when I heard that sort of the LPs hadn't been quite working 100% of the time. Having done 2 liquidity calls already today and 3 after this webinar, I think we're up to about 120% per day.
Yeah, I can just share that, and I was on another discussion with a couple of Asian and US people doing a Zoom conference, and I can just share that with some additional additions. That's what I hear all across the industry. GPs, LPs, everybody was able to transition to a work from home mode, to adapt to a new online working atmosphere. And I think how I can summarize this first question around is that the communication between LPs and GPs intensified, and also between GPs and the management and the portfolio companies. And to add from my side, it's all across the globe. And as Mark, to your point, sharing best practices is really a key thing here, and something where a GP really can add value. And I think we will touch on some of these points later. Going a little later, and Mark, you kicked it off, we're kind of going into phase two with 6, 8, 10 weeks into this, depending on what country you're in. And you said working on liquidity, but beyond that, when the first rescue things were done, what is now happening this very moment beyond the liquidity management? Again, to maybe Mark, we keep the question with you. what is kind of the next phase as you started? What is phase 2 from your perspective? What will be the next thing to discuss with the management teams in your portfolio?
So I think there are 2 key areas that I would highlight. The first is preparing for the end of lockdown. So simple, practical things like making sure each of our businesses has protocols in place to deal with social distancing, that our staff have adequate PPE at their disposal in order to continue to carry out their business in the best possible manner, to plan for the 2-meter rule in the UK and other distances in other jurisdictions, so that the businesses can get up and running as quickly as humanly possible. And we have got businesses that have started manufacturing this week, in fact. And then I guess the second key topic is for us to not waste a good crisis. So to look at how we've conducted business in the past and to really verify whether all of the costs that we've managed to cut in this period are things that our companies need to be spending money on in the future. And then I guess the sort of second half of that is, as the Americans would call it, we're looking to play offense, because a number of our businesses have got very strong liquidity in areas where their competitors possibly haven't. And so whether it's via M&A or whether using that liquidity to help out people in our ecosystem by extending payment terms and therefore grabbing market share, we're very keen to do the very best for our LPs. And so we're looking at every avenue really in that respect.
And coming to that point, private equity was often criticized for being for kind of the practices they were having. Would you say it's a fair statement that PE-owned companies will get better through this than publicly listed companies or privately held companies without the backing of a sponsor?
Yeah, so I guess we're very fortunate because it's part of our DNA. Having started off as really a sort of a turnaround specialist, we'd already for many years been doing 13-week cash flow forecasts. So we really just sat down on day one of the lockdown and said, okay, what's the impact on the 13-week forecast? And what are the measures that we need to take? So I do feel fortunate compared to what I would describe as the hands-free or the light touch private equity, because we were already in those businesses and our operating partners were already having a regular dialogue. Obviously, that dialogue's moved from what I would describe as a regular dialogue to a weekly liquidity call with each and every one of our portfolio companies, both in the UK, the rest of Europe and the US. But even then, over and above that at investment committee, we're sitting down and going through what I describe as phase 1 and phase 2 reviews with the management teams of each of those portfolios, so that we can ensure that they've done all the measures that they needed to thus far, and they're very well prepared to implement all of the measures required once the lockdowns, plural, start to ease in the countries in which our portfolio companies are active.
Peter, to bring you into here, how do you, is there, you're active in the Irish market, as I said in your introduction, you work of a Carlyle-backed fund and now has spun out of Carlyle. What do you see in the Irish ecosystem? Is there anything different, or is the advantage your portfolio companies have even stronger there? Please share some insight with us in the lower mid-market from a size perspective, and also geography focus in Ireland.
Sure. Similar to Mark, I think, you know, for us now, we've reached that stabilization phase. So we're still obviously heavily interacting with our portfolio companies. So we would have divided our companies into low, medium, high risk. Clearly, the low risk ones get a little bit less attention, but the high risk ones get a bit more attention. So somewhere between daily and weekly calls. I think that, you know, we're talking about things like the scenarios that we ran originally and updating those. We're talking about liquidity and business plans. But now that we've stabilized, we have moved on to that next phase. With all of these companies, we're looking at how we can come out of this crisis in a better way than we went into it. So, you know, we're looking at things like opportunities that might bring. So, you know, increased digital presence in some industries, and what opportunities does that present for us to grow market share, more flexible working. How can we use that to increase employee satisfaction, reduce churn, improve efficiency? So a lot of our businesses will have daily peaks and troughs, and you know, can this crisis and the move to working from home allow us to take advantage of that? And that's the type of stuff that we're doing all the time. I think to answer the second question around will PE do better through this crisis, I guess the whole model of private equity is around you know, driving better returns through more active management. I think, you know, to Mark's point, the days of hands-off private equity, I'm not sure are around anymore. I think every manager from Sun Capital at the larger end to ourselves at the lower end, everyone is very active within their portfolio companies, and we spend a lot of time, you know, looking to optimize performance across the portfolio companies. And again, it's things like Mark mentioned around sharing best practice amongst the CFO and the CEO community, helping work through things like the government assistance programs, making sure that management teams who mostly have never been through a crisis of this scale before are not caught in hesitancy, and making sure that corrective action is taken quickly, and being a sounding board to your management teams. I think around leverage is clearly a challenge for companies who are private equity backed, but again, with an experienced sponsor behind you, I think these companies are very well guided through some of the challenges that leverage brings. In terms of Ireland in particular, I'm not sure how many of your guests on this webinar are that interested in Ireland, but to give you a very quick perspective, I think Ireland is probably mid-table in terms of the impact of this crisis from a health perspective. We've had somewhere around 20,000 cases and 1,000 deaths, but we're a relatively small market. In terms of the macro situation, Ireland entered this crisis in a very, very strong position, and managed actually just 2 weeks ago to borrow multiple billion euros at a yield of 26 basis points, even in the teeth of the crisis. So I think Ireland entered the crisis relatively well. The government has taken action which seems to be taken all around Europe in terms of protecting both individuals and businesses. And I think now is thinking about how we get out of the crisis. And I think it's very interesting to watch around Europe what different governments are doing. I think Ireland is being relatively conservative in terms of the pace of the route out of lockdown. There's the constant debate, Robert, around health versus wealth, and I think that's going to be something that's prevalent across European economies. But for us, we're fortunate that our portfolio is well positioned, and most of the companies are now looking to take advantage of the crisis and come out the other side strongly. Okay, thanks for adding that. And now looking to the LP side, how did your view on PE change over the last weeks, and how are LPs reviewing their PE allocations? In the introduction with the frequent presentation, we had some data points, and there was some statements on reviewing the PE allocation. Obviously, Preqin data set is putting together a lot of data points. Now we have two LPs sitting here. Joaquín, the European Investment Fund, what is your strategy? And as you have also a kind of a political a European institution background, how is your view on how what is the view of the European Investment Fund at this point, and what is the planned level of activity? You gave a description of last year's program was 3.5 billion, roughly 100 commitments. Will that increase? Will that decrease? Will you focus on other parts than primary allocations? And share some insight. What is the discussion inside the IF? What can you share with the audience about
rethinking private equity allocations, and where will the money go?
Okay, thank you. So I think there are different things to take into account. As you can imagine, EIF is a public-private institution that is meant to have in this very particular environment a counter-cyclical role, as we had in last financial crisis back in 2008, 2009, 2010. Now, the question is, how do we support the market? And I mean, EIF has essentially two business lines. One is on the guarantee space, and the other one is as a private equity fund of funds. On the guarantee space, EIF will be very active, increasing its volumes of guarantees toward financial institutions, essentially banks, so that these banks can on-lend to small, medium-sized companies, what we call small caps and also mid caps. So that's one big action plan that we are working on, and that is actually already live. On the private equity side, we are also developing a number of measures. These measures may have some different products. It could be from EIF having I would say a larger stake in funds in which it is investing, funds that are therefore still in the fundraising period, in the subscription period. It could be what we would refer to as funds or co-investment funds, co-investment pools, so that through these vehicles we can help existing portfolios which are in difficulty. So these would address situations of funds that have probably drawn most of the capital from LPs, and with that situation in mind, might not be able to use or might not have in place credit facilities to support the existing portfolio. From other types of measures. You were asking if we see ourselves having a more active role. I do think so. And in terms of volume, it's difficult to predict. It depends on how big the different mechanisms are trying to put in place will be. But my views are that we will be deploying very likely bigger amounts than what we have done last year, precisely to help the markets. In terms of opportunities, I mean, EIF is predominantly a primary fund investor, but we on other segments, on other products like secondaries, and I think that not on the short term, not necessarily in coming weeks, but probably towards the end of the year and in coming years, I can see that there will be good opportunities on the buy side, and I can see EIF seizing some of these opportunities, especially within its portfolio.
Great to hear that EIF is taking the responsibility and providing liquidity in situations where maybe funds are in a situation where they need extra liquidity, and also providing liquidity to LPs on a secondary market that might need it, and that this is in preparation. Even on Federated Hermes as an advisor to a broad variety of pensions and LPs in the market space, and given your background, how do you see the changed view, or is there a change at all in the perception of private equity from the LP side in this kind of open market if you don't have a political mandate?
Yeah, I mean, I think there has to be a changed view. If we don't have a changed view, we have learned nothing from the last crisis. And what are we if we're not, individuals who learn from our mistakes and hopefully avoid making them again? And I think it's critical that investors have a highly analytical and somewhat skeptical approach to what they're hearing from their private equity managers right now. And I saw this, I'm not sure if it is from aviation or not, but I'm very happy to adopt it myself for investors' mantra, ABC, which is assume nothing, believe no one, and check everything. And I have to say, you know, having been where I've sat at many different sides of the table, and I think that's an advantage because I've been on the fund manager side. I've seen how important it is to be transparent with investors, but I've also seen, I'm not saying I've done it myself, but I'm saying that I've seen smoke and mirrors being spun for investors. And I think that, mixing metaphors there, but I've definitely seen a wool being pulled over investors' eyes, to throw a third one in. And I think it's really critical that investors take nothing at face value right now. You know, it may well be the case that private equity is an active manager, but how do we know that they're experts in, say, waste management or, you know, software, this particular kind of software? How do we know? And how do we know that they didn't just learn their tricks in the last iteration of that particular sector, and that they're not well equipped for the next iteration of that sector? How do we know that they're applying the sufficient level of high-level expertise? And I think we have to remember that many of the mid-level professionals today have never seen a crisis. They've had 10 years of a bull market. There is something to be said for a little bit of gray hair here. So I really think that investors need to be highly skeptical of anything they're hearing. I think they need to probe everything that's coming back from their managers right now. And that's just in the near-term triage stage that we're going to be at. As for the long term, it'll really depend on the investor's own understanding as to the level of transparency they got this time round, their comfort level with this. And I think then we will see where they end up placing their money, whether they want to support big buyouts. And I think it's fair to say that whereas a lot of private equity has behaved admirably in the current crisis, we've seen other entities that have been quite proactive in terms of furloughing employees, perhaps you know, not paying their rents on their properties, and perhaps displaying quite sharp practice in that respect, which may not be in line with what we would expect from good corporate citizens. So investors will have to decide for themselves where they want to support and who they want to have as their partners. And I would expect there will be a focus more on ESG themes, as well as perhaps looking at some distressed opportunities. And really how a manager conducts himself during this crisis will be the defining feature as to how they are able to build support and investors going forward.
Even I would like to dig a little bit deeper into what you just said. And where do you think will be key challenges for the GPs and the funds from your perspective? We have heard all the good things GPs say of sharing best practices, and I don't want to draw a negative picture, but from your perspective, as you just say, A, B, C, where do you think key challenges will be, and what is your view in the preparation discussion? We talked about very high valuations at the end of 2019, the level complexity of transactions, the levels of leverage, and beyond the sharing of best practices, and where do you see really where will be the separation between the good and the not so good GPs, and what will be key challenges?
Well, hopefully the investors have done good due diligence at the outset, and they're invested with a group that they trust. And it is really key to have trust. And I think what will be, I mean, but you can lose trust quite carefully. It's quite easily, should I say. And I think a way that GPs will retain trust right now is by being extremely transparent, and that may involve admitting mistakes. Because I don't know many that have had forecast this type of spread of COVID-19, this kind of steep fall off in cash flow. I don't think anyone had. And that probably was a planning error. We didn't know it was going to be this type of a black swan, but we should have perhaps had a downside case that looked into this type of systemic risk. So there will have to be an admission of mistakes. I think taking investors on side early on will be good to really build that trust. And if that trust is there, then when GPs do need to look at perhaps stopgap measures, such as maybe taking on preferred equity, or maybe trying to do another drawdown for some of that dry powder to actually support the existing portfolio companies, they're much more likely to get investors on side. They may need to think about some fee reductions, depending on the situation. But hopefully this is a partnership. LPs will be treated with respect and seen as collaborators and partners, which is what they are.
Joaquín, on the LP side, where do you see challenges, especially as you, with your European Investment Fund mandate, also invest in first-time funds in managers that are relatively young? Where, when you go to your previous role in the primary investment team, where do you see key challenges? We can't hear you.
Yes, can you hear me now? I think so. Well, I mean, the first comment that I'd like to make is that, I mean, most of our GPs, I mean, they've
Joaquín, we can't hear you. Maybe it seems like a technical problem here. So sorry, we will maybe revisit that at a later stage. Next question. We spoke about the immediate response, then the GP perspective of sharing best practices, how actively involved GPs are currently, what the challenges are from the GP perspective with liquidity management, sharing best practices about health and safety, and now getting into a phase 2 approach, and where are the opportunities and how can we win market share and so on. And we have gotten some insights from the LP perspective and seeing where is maybe a little bit of skepticism and also a kind of this ABC principle of really expect nothing and check everything. Now let's speak about something, and it's always a question that is on my mind, and how we work in our team is, where do we have a blind spot? What are we missing here? And what might others see that we are not seeing? So we always, in our analysis, try to come to a point to reflect on things, what we have might missed. And as obviously this is an unprecedented situation, there are new things coming up every day. And Peter, starting with you, is there a specific thing in the current debate, especially among private equity people, where you think this is maybe a little too short-fetched? We might miss something here. Please share if you have any thoughts on this. If we are missing something here.
Yeah, I'm not sure I quite get the question, Robert, but I think, listen, the thing that we're focused on is making sure that the portfolio companies are well looked after, as we've discussed at length already. The question really on everyone's mind is how quickly we get over this, and how best to position your companies to get over this at the right time. And I think that's a key challenge that everyone with a portfolio is wrestling with. You don't want to go too early because you might look very silly, but you also don't want to go too late because you'll miss opportunities. And then if I think about private equity managers more broadly outside the portfolio companies, as you think about new transactions, how do you, going forward, underwrite things like pandemic risk? And I think that's going to be a massive challenge for our industry going forward. You know, financing institutions, investment committees, how do they think about pandemic risk? Can you insure against it? Will GPs ever be able to invest in travel and hospitality businesses again? And how quickly might they be able to do that? So I think for me, as I think about our industry, I think there's the immediate challenge of making sure that our portfolio companies are very well looked after, and I think we're all doing our best to do that. But then as you move forward, I think, what's the new reality going to be? Are certain industries going to be absolutely out of scope now because you just can't underwrite some of this risk? And how do you think about that? So that's just something that's certainly on my mind.
Mark, your view. What are we missing here, or what might be the crucial things here looking forward?
Yeah, well, I mean, first, thanks very much, because this is natural and not a colouring. So appreciate the grey hair comment. Look, I think it's very much, as Peter's already just outlined, we do have blind spots. We've made mistakes in the past, to Aoifinn's point, and I think we've got the humility to look back on those mistakes over the many, many years, particularly in the case of Sun in areas like retail and restaurants, where fortunately previous funds invested heavily in those, and we stubbed our toe as a result. And therefore, we've been able to learn almost using a black box technique of going back each time there was an issue and studying the tape and seeing where mistakes were made, so that this time around we're making fewer mistakes, and also we're able to assist those businesses in the retail and restaurant arena to a much, much greater extent than we could previously based on past experience. So that's the first thing. I think the second point is I do like the idea that we will continue to maintain our badge as being a good citizen. And so that's how we think about things in investment committee. And that's how we act. I mean, earlier this week, we sold a restaurant chain in the US for $1, which will now get not insignificant support from the US government through soft loans, etc. But we didn't want any proceeds. We wanted that money to be plowed back into the restaurant chain in question, because we believe that that would maximize how many employees would be retained and how much of the business would survive in its amended form. So these are things that everyone's out there looking at. I think just the last point quickly on Peter's point about pandemic risk, I don't think we'll be able to insure it. And unfortunately, the reason I say that is that the insurance companies were very quick out of the box around 2003 and the SARS issue, and basically took a pen and made sure that communicable diseases are no longer covered in any insurance policy. And so everybody who's tried to claim as a result of COVID has been told exactly that. So I think, yes, investment committees will have to look at flexing the models, looking at downside models as well when we come to underwriting. But I don't think there's a silver bullet for how you deal with future pandemics, unfortunately.
Aoifinn, something you already touched a couple of points, maybe specific to the question. What are we missing in the general debate, or what is a specific area you think that needs more attention, specifically going forward?
Say first of all, I think the private equity players need to be quite upfront about the situation regarding credit facilities. Private credit is definitely going to come under a lot of pressure. If they need to have an existing facility, to extend an existing facility or get a new one, what's the kind of pricing that's going to have? What impact is that likely to have on returns? I have heard that there are some private equity funds that they're looking to buy up some of their debt in the market as it's been trading down, that can be done sometimes through a front of some kind. I'm not sure, I haven't verified that, but that seems to be something that might be of interest to them. But in a way, I'd like to know how to unpick the knot between credit providers and private equity, and just to really understand that. I'm not sure that we really do understand that. And in addition, some of the many interconnected aspects of this this current, I suppose, valuation crisis as much as a financial crisis.
Thank you. And Joaquín, I hope we have now a good internet connection again. As said, Aoifinn is a big animal, a big portfolio. You look into many funds. Maybe from your perspective, and also with your mandate and kind of an overall view into the PE market, where do you think we will see effects that are currently not broadly discussed or not in the data sets we share in the quarterly, in our weekly reports and newsletters? Where do you think, looking on the market as a whole, are things that need more attention?
Well, I mean, I think that one of the key areas that we are all, I don't know, but at least we want to see what, and probably even more Q2 NAVs. I think there is a big question about how this will evolve, especially when compared to Q4 2019. And also what will be the approach and the different methodologies, irrespective of what Invest Europe or the the international private equity valuation guidelines may indicate as a best practice in the current moment how our different GPs will apply these different methods in order to value companies. I think that's going to be one of the big points of attention in the coming month.
Thank you. Now coming to a point we had early in the frequent data set, and basically why we are here is generally LPs have a strong interest in the private equity asset class due to historic outperformance and relative strengths compared to other asset classes. Now, going into this crisis, where do you think performance of private equity will be relative to other asset classes? Open to the group. Who wants to pick up on it? Where do you think performance will go, and how will private equity perform, for what reason, relative to other asset classes?
I think there's going to be a real bifurcation, because I think those private equity funds that have saw high leverage, and we saw this after the GFC, they owned very good businesses but had completely the wrong capital structure when the downturn came. And the performance of those assets, I think, is going to be mediocre at best. And I'm using a very diplomatic phrase when I say that. I think the sort of the assets where leverage has not been the driving factor, and moderate leverage has been used in areas where the business was recession resistant. We can never get recession proof, but somewhat recession resistant. I think those businesses will perform sufficiently well to return the type of MOIC and IRR that our LPs are looking for in private equity. Now, that's going to lead to the sort of the haves and have-nots, if you like. And there will be some funds which I think will underperform the market, and those that will overperform. But in general, I still think it's a good asset class, because I think the returns compared to the public market, which has obviously endured its own bloodbath recently, will continue to be superior.
Joaquín, I think you started to say something, and then Mark took over.
Yes, well, I mean, I think completely share what Mark said. I would like to look forward, and it's often it's very often said, and I would say the empiric data support it, that investments that have been done during a crisis, as we saw in the past, tend to be the best ones. I think that good GPs will be able to capture good opportunities, and we will still see superior performance on the private equity as an asset class versus other asset classes in general in coming years. So on that side, I'm actually quite positive. I think it's definitely a good asset class, and investors should not walk away.
Yeah, Robert, I might.
Please go.
I might just commit. I think Mark's absolutely right. It really depends on the strategy being deployed, and private equity covers such a wide sphere of activity. It's hard to bucket it all in one. And for us and what we do, we're buying lower mid-market companies at relatively favorable multiples. The leverage that we would put on a company is much less than it would be on a large buyout. And really, our strategy is all about doubling and tripling EBITDA of the companies that we invest in. So it's not what's called financial engineering. It's about radically improving and enhancing and growing the businesses that we invest behind. So I think the crisis will be different depending on the strategy. And as Mark said, different strategies I think will be more severely impacted by this than others.
Just for reading out from my notes and kind of summarizing that question before coming to a next one. So one thing you say, and what we can state is there will be a bifurcation on the level of leverage a business can carry, and if it is over leveraged, it will underperform, and if the leverage was low, conservative, appropriate, those businesses will A, survive, and B, have an opportunity to gain market share or outperform. Second thing, lower mid-market size of businesses. Peter, you pointed to that maybe highly leveraged large cap buyouts will have more difficulties than smaller businesses that might be faster to adapt. And also in point from Aoifinn earlier, complexity. If you have a highly complex structure, that might be more difficult to bring through this phase than an easy business and a local business. So I think it's fair to assume that this group, and I would be surprised if you would have said anything else, is convicted and convinced that we, as a private equity asset class, will perform if those things are applied better than other asset classes. Now let's look a little bit into the future, and where do you see sectors and areas which are now a good opportunity to look at? So what keeps you busy to the GPs to start with, and then coming to the LPs where they see the opportunity? But where are currently sectors and areas? Do you have already an early view of where opportunity might lie, or are you still kind of in this bunker mode you earlier said? So, and when do you think that these sectors will kind of become obvious and will become visible? Peter, Mark, from the GP side.
It's relatively easy because we focus on really 4 verticals. Healthcare, which I guess normally you would assume is going to be an interesting sector. Unfortunately, because of what we're going through, I think you've got to be very selective, because some of these businesses will go to very high valuations and the crowd will flock towards them. So we try to be differentiated in our approach. So we're being careful at the moment in terms of healthcare. We've got some very good healthcare businesses in the portfolio already, particularly in the US. Industrials has always been a strong part of our activity. And I think particularly as before COVID, industrial technology businesses where we can demonstrably improve productivity, get back to the point that Peter made, which is doubling and trebling your EBITDA is a lot easier if you have that type of technology behind you. And then business services and direct to consumer. I've already outlined that we wouldn't do retail and we wouldn't do restaurants, and I don't think that's going to change anytime soon. And I think that probably applies to most people in private equity who own those types of assets. So they're the key areas, but I think it's too early to disclose that a particular sector is going to benefit more or another will benefit less, particularly in a webinar where we've got many people who I'm sure will be taking notes as to what we're discussing.
Okay, unfair question, point taken. Maybe coming to the LP side, where when you look with a broader perspective into the private equity market and think about where things are going, have you already some early thoughts about where winners might be and what sectors might be positively affected, or what strategies? Nobody's really jumping at the.
No, I will. I'll just come in. I think we all made the point about it. Really depends. It's an easy answer. I'd say it's going to be very interesting to look at whether larger companies have better tools. Larger, say, firms, GPs have better tools at their disposal right now. I heard about one large GP that has hired infectious disease specialists on staff to help them to get their portfolio companies perhaps ready for reopening with sufficient, disinfection, etc. So I'm not sure whether there's a benefit of scale in that, and just the ability to get access to experts, and maybe also a better capital base to weather a storm. So that may be a point that the larger firms will prevail. I think that I would say that investors who invest in co-investments and secondary funds might really want to pause now and understand the real driver of the returns there. And co-investments could well be a lot more disadvantageous now, given the lack of control of any kind that the investor has. Whereas secondaries, I would imagine valuations are an even greater challenge there, and they do have leverage in place too. So whether that is going to make them even more difficult to understand their valuations.
Oh, okay. Yeah. So, please.
Yes, I wanted to add that as primary investors, we're much on the mid market, generalist focused. So in any manager that we would support going forward, I mean, you would never find, or you will rarely find a GP that is focused on one sector or one subsector. At the end of the day, they would also cover 3, 4, 5 verticals on which they have gained experience over the years. Now, in terms of sectors, it's difficult to predict. Although there are probably early winners, as we've seen over the last weeks. We've seen some of our e-commerce businesses performing pretty strongly. Obviously, having some issues perhaps in terms of logistics, in terms of inventories, so on and so forth. But we are also seeing logistic business, which maybe in the past some of them were not particularly now are actually quite in demand. We will also see anything that is food related as a performing strongly. And we may see, as Mark said, some subsectors in healthcare in general also performing strongly. I mean, I also think that, I mean, there's going to be different strategies. I mean, co-investments and secondaries. I think when we look at the market, it's a market that is in standstill. That's clear. I mean, one of the key elements in both sides of the business, but especially on secondaries, where I'm active now. I mean, you need to price assets, right? And at this moment, pricing uncertainty would very likely translate into big discounts on NAVs that are not really relevant anymore, and that won't be very relevant for the coming month, coming quarters. So I can see that it will take a little bit of time for the secondary market to come back. It will take time for direct GPs, direct investors to have conviction on fundamentals of businesses and know where the bottom is, and therefore to actively invest. When this settles down at some point, I hope probably by the end of the year or beginning of 2021, I mean, markets on direct investments, on co-investments, on secondary should come back hopefully, and we'll have more visibility on what are the opportunities.
Thank you very much.
I would like to just come in there quickly. I can't let Aoifinn away with the perspective that the larger firms will prevail. I guess as a lower mid market focused manager, I think that you can find very nice recurring revenue resilient businesses in the lower mid market. You generally pay lower prices. As a result, your capital structure is more resilient. You're dealing with local commercial banks, and again, that generally puts you in good stead through a crisis. In terms of what we're seeing across not only our portfolio, but what's doing well, we've an e-learning business that's doing particularly well, very nice recurring revenue. Consumer staples in the food space doing very well, and healthcare doing well. I think for us, the challenge again is going to be, as Mark pointed out, even a business in a resilient recurring revenue space will be impacted by the broader economic malaise. And how quickly will business owners in those industries adjust their price expectations? Because if you felt your business was worth 100 3 months ago, it's very hard to get your head around that it's now only worth 70. and that always takes a little bit of time to get worked through the system.
Thank you very much. So we just got the message that there will be a Q&A in a couple of minutes, and I want to summarize and use the last minutes to for the benefit of everybody who joins the webinar. First, to thank my panelists, to thank the organizers, to thank Preqin for sharing the data, thank all the attendees. It was great to see close to 200 people joining. So thanks for that. I've seen a lot of messages flying by in the chat. I wasn't able to read and participate, obviously, but will do so afterwards. And I've seen that already a lot of questions have been asked, and we will be very happy to go through those in a couple of minutes. Let me summarize. I think the key takeaway here is the industry was affected as every industry by COVID, taken by surprise. But I think what we learned and what the panelists shared and what I can share from a Silverfern background is that all firms were very quick to adapt to a new digital work from home and work safety environment, and firms across the industry were able to share best practices and to share the knowledge that was needed to really come to a safe mode of operation. So the GPs had the playbooks in place, and I can speak for us. We have a lot of experience, and gray hair was a common, and experience here really helped, and experienced management teams in the portfolio companies and experienced managers in the GPs that were able to really go back to those playbooks and who have done it before, to really go, Mark said it, the 13-week liquidity plans, and Peter said, you know, all the tools you have been in prior roles, you could really pull out of the drawer and go back and help the portfolio to stabilize. And also the LPs who had been through crisis before and who know what is coming, who have the discipline and did not panic and went to a stable mode of operation. Then phase 2 came, where things have been stabilized, and and we might be in that phase, first early look to see where might opportunity come, what is the right tactics to go from defense to offense, was a word used. And then I can also just reconfirm same thing happening on our side, to see after things were stabilized. And we were in a good position, as most of our businesses were, or all of our business are leveraged relatively low compared to what other people did. And those businesses are now in a good position to slowly, and to a point earlier made, you don't want to be the first fool to do a mistake, but everybody is cautiously waiting, where is the opportunity, and if you have used leverage conservatively, and you have the experienced management teams, and those things come together, and you have a good financial support, you are in a role which might allow you to benefit from this situation, to say cautiously at this point in time. I think is a fair summary to make from what you shared with the audience. We learned that there is also a political motivation and ESG from an LP perspective. So Aoifinn made the point. We shouldn't. A lot of fundraising activity the last 2 years was around good business practices, ESG responsibility, good corporate citizenship, and so on and so forth. And obviously, we learned that LPs are watching this, and how are GPs behaving in these situations, and do we fall back to habits that the industry might have had decades before? So there are LPs watching on the sideline to really see how are GPs behaving, and even reminded us on that there are people out there watching what the GPs are doing. And Joaquín was a very broad overview on the whole PE fund ecosystem. Made a good point and said, okay, the European Investment Fund also was a political mandate, is there, and is currently working on his plans to be there. by increasing guarantees to the banking sector to provide liquidity in the banking system, to provide financing to funds that might be in a position that they don't have the extra dry powder through various forms and programs. And there will also be more activity in supporting fundraising that might have found itself in difficult waters, as the frequent data shows. Fundraising came to a difficult point in 2020 with a COVID impact. So I hope for everybody that we touched on a lot of important points and perspective, and thank again the panel for sharing these insights and sharing what's happening in your firms with the audience. And so I want to give it back to the organizers of this conference to go to the Q&A section. Joseph, do we have to change anything, or are we just going to the question Q&A section? Okay. Joseph is not reappearing. So I think it's on me to open the Q&A section. Yeah, so thank you. Part of the panel discussion is closed. We now go to the Q&A section. And I start with the first one, and I think you have figured out ways to push up questions. Hannes Ambacher, during GFC, there was a significant opportunity for the secondary space. Given the fiscal stimulus and other measures, the impact on the market, it appears that this time the secondaries opportunity may be far smaller. Perhaps it's even business as usual. Yeah, Joaquín, this is perfectly teed up for you as being a great participant in a secondary space. How do you see the secondaries opportunity coming out of this? You're on mute. When we need him the most to answer the secondary question. Joseph, any chance we can bring Joaquín here? Nodding heads. Maybe we go to another question and you're back?
Looks like.
Yeah, okay. So please share with us an audio. So
yeah, well, again, I mean, as I said, I think that the market is in a standstill mode right now. But if we draw parallels with the last great financial crisis in 2008, 2009, we can see that there will be opportunities for sure, but most likely towards the end of the year or in the coming years. It would not be correct to say that we may see a lot of investors defaulting right now. For example, that we may see investors that will be pressured to reallocate, their positions into funds because of the so-called denominator effect. I mean, this is having an impact, no question. But at the same time, we have seen how the public markets went down in a matter of weeks, 30%, and then rebounded a few weeks later. So I would say this volatility at the moment is still present, and therefore that's why I don't think that we will see a lot of sellers going to the market in the coming weeks to try to exit positions. But in the midterm, both from underlying GPs that may look for secondary direct opportunities or for pure secondary players to buy out positions in funds, this will come back to normal at some point. Maybe not at the level that we have seen in the past few years. However, we should be able to access quality deals at will be much more reasonable than what we have seen in the last big years. So overall, I think the market opportunity will be there.
Great, thank you for answering this one. And I'm just reading through the questions, and there have been posted many questions as we speak. So please excuse if I overlook something. But to the GPs, 2 or 3 questions came on the topic of leverage and a topic often discussed, the levels of leverage reaching pre-GFC levels at the end of 2019, and now the leverage market is it closed? And when we are through this, do you think what is your view on leverage? And to just pick up that question, Mark, Peter.
Yeah, sure. It goes back to what I said previously, which is some parts of private equity have taken on too much debt. And I think they will look at more moderate capital structures going forward rather than pushing the envelope. At least I hope they will, and that we'll have learned the lessons that were already there after the GFC, and will certainly be there again to the Power 3 post COVID-19. So I think, as Peter said earlier, and I'll pass on to him in a second, we don't push maximum leverage. And I think people who have done that will be those that suffer most as a result of the pandemic crisis that we're currently going through. The second part of your question, is the market closed? I would say so for all intents and purposes. I mean, you can have conversations with banks who essentially offer you half of the leverage that they would previously offer you at twice the price. But my experience coming out of the GFC was that you could ask them to go to credit committee and there would be a technical reason why, unfortunately, the deal was declined. So nobody says they're closed for business, because then they have to go around the market saying we've reopened. So everyone still has a sign saying open for business, but I would take that with a pinch of salt.
Yes. Peter, you want to add?
Yeah, it's a slightly different perspective from the lower mid-market in Ireland again. You know, we've actually just successfully about 3 weeks ago refinanced one of our companies. It's in a relative, but one of the local banks at a relatively modest leverage amount, and we managed to refinance it. You know, drawing on our relationships with that local lender, their view on us as a sponsor, and obviously the quality of the business. So Mark, you're absolutely right. It depends on where you are in that value chain, but not quite shut here yet.
Yeah. So that was a question by Tomasz Stamiorowski. So thank you for that question. Then we have a question from Mariano. Hold periods and long-term capital structures. There was also a topic getting more discussed over recent years, that kind of funds were extended 10-year life, 15-year life, and different strategies. Maybe to the LP side, would you do you expect, Aoifinn, to throw the question to you, do you expect that the hold period will increase, and also is there a demand from the LP side to invest into longer running funds, 12-year, 15-year evergreen structures?
I've seen these structures arise, these very long lockup structures, kind of akin to permanent capital, but I've never seen an LP interested in pursuing them. But there must be, because clearly there's a lot of demand for these, and there's a sense of a lot of competition for the best deals, as well as the best GPs, as well as you know, very, I think probably a flush fundraising environment, certainly for the larger groups over recent years. And that's, I think even the large groups will have admitted that it was in the easiest fundraising environment they've seen. So I would imagine, certainly I think hold periods will be longer, which in a way takes some of the problem away that investors had, which is, and I saw this in private credit, that investors were getting their capital back a lot sooner than they expected. And then they had the onus to reinvest it somewhere that was actually going to get them a similar rate of return. So that was actually quite a lot of pressure. So whereas there may have been these high IRRs coming back, the total return was quite a bit more muted given the low rates of return on cash. So this may be that problem gets solved, that there is now, that there will be longer time periods, I believe. But, you know, I think there will be an increasing focus on the likely pattern of cash flows, and investors need to make sure that that's going to work for them. And as I said, there could well be these large strategic partners that want the longer lockup capital. I just don't seem to know any of them.
That's good. On the Aoifinn side, any appetite for increasing fund duration, or is that something that is often discussed and never done?
Well, I mean, more than appetite, I think that we will have no choice, to extend subscription periods of funds. I mean, we'll have to be flexible, because we can see a lot of our underlying GPs, having had to postpone, on-site DDs that were, meant to happen perhaps in this month, and that will only resume eventually post summer, until the lockdowns are out, or at least partly out. We will see some of our fund managers that were close to the end of the investment period, perhaps with a number of transactions pretty advanced on the pipe, putting things again for some time until they can understand what is the situation, what is the impact on underlying transactions. Some of them may or will be forced to reprice transactions. Sellers might not be willing to transact on such basis, which would be completely normal. So that would mean that we may see a number of our fund managers coming back to LPs and asking for extensions of investment periods, as we saw in the last global financial crisis. We were discussing at the beginning that distributions may take longer to come. That is a reflection of exits not materializing when this was expected. So this translates at the end of the day in longer holds, and as a result of that, funds will be in place for longer periods. I mean, that's inevitable. Now, I agree that we've never been we haven't really backed any evergreen structure. I think that's not something that well, first is market practice, and second, something that we would typically support. Can we imagine in some cases these very long funds, as we've seen from some of the largest PE asset managers worldwide? Well, I mean, it could be, but I don't think that the industry is going to reinvent itself on that front, to be honest.
Okay, thanks for that question. Then there are a couple of questions I want to summarize on the fundraising environment. The Preqin study shared some data with that, and specifically there were a couple of questions on the first-time fund side. So again, LP question. I will pick another one for our GPs here after that, but maybe a quick statement. Is it a good time for a first-time fund to go out to fundraise? And generally, what do you see as a fundraising trend? Will there be a full stop? Do you think when do you think the fundraising window will open again? Joaquín, you kind of have the European.
Yeah, sure. Okay. No. I mean, I can answer that question again. As I said, we can see a number of I would say fundraising being put on hold. I mean, that's normal. I mean, that's not the priority for many of the investor of the LP community at this moment. Having said that, if you're managing a large program, I mean, you cannot stop investing. You can delay investing for some time, but at a certain moment you have to restart. I think we were discussing this before. Best vintages will come after an event like the one we're going through. I would say that second half of the year 2021, a number of fundraising processes will resume. You were asking the question if it's a good time for first timers to start. Well, I mean, I think it's at the end of the day, as an LP, if you've done your homework and the due diligence was satisfactory on the quality of the team, on the capacity of the team to identify good companies, to add value, irrespective of it being a first timer or not. I mean, I don't think that we would change our mind. what may happen though is that that team will need more time to reach a first close. I mean, that's inevitable. But at the same time, we have seen a lot of first timers or emerging managers spinning out, for example, of a sponsor, performing very well and even better than established managers. So clearly on our side, I don't think that we will not be supporting this type of initiatives as we've always done in the past.
Thank you. I'm scanning through the question, and I see that there is kind of a voting mechanism here. Maybe from Otto Karsh, and it touches multiple questions. Again, the sector and especially healthcare and life science. And Mark, I think you said that is one of your verticals. And maybe Peter, you can add something on the Irish side. But is there what is your view? And maybe we start with you, Mark, and add something to what you said previously. What's your view on healthcare, life science, and will that be hot? And would you go earlier stage, participate in other forms, or do you see a great opportunity there? Maybe it's a fair way to summarize.
Yeah, I think it's a very structured sector, though. Anything which is early stage is really outside of what we have committed to our LPs we will be investing in. So certainly chasing vaccines, looking at that sort of thing is clearly going to be hot, but with a high beta. So if you invest in a company that finds the vaccine, great. If you're one of the investors in the 55 other companies that hope to get the vaccine and don't, then it's clearly not so great. So as a buyout shop, we tend to focus on what I would best describe as healthcare services. And I think that is going to be an interesting area as well. But it's going to sort of take time to see which parts of the value chain offer the best opportunity.
Sorry, so here's a webinar moment. My daughter is coming in.
Over to you.
Thanks, Mark. I have a lot to add to that. You know, similar to yourselves, we are a growth buyout fund. We really like healthcare. We've done a lot in healthcare. You know, we think there's great businesses to be found. They're expensive, but there is great businesses to be found and some really nice characteristics around them. Early stage is not really of interest for us. The distribution and volatility of returns in early stage is it's someone else's cup of tea. So it's not something that we would seek to get involved in, no matter what the environment.
Thank you for that. So I'm looking through the questions, and maybe also to the panelists. I think you have the same feature on the right side. Maybe if you want to jump at a specific question, I don't know how to mark those that we have answered. Upvotes. Now I see. Saying again, any kind of long-term I think early stage recipient may be affected. Healthcare, LP's attitude, long-term. Any advice to give somebody? Climate funds and maybe to the ESG point, we have seen a couple of funds with a specific philosophy and specific focus on climate. And I don't know, we were on a discussion the last 2 days on a global private equity conference that happened to be online today in these days. And we often touch, you know, it seems like decades away to think about December demonstration on Fridays for Future and other things, but there were topics pre-COVID. And what do you think will after the dust has settled after COVID, will will healthcare and health be the dominant theme, or do you think we will come back to the intense climate debate we had prior to this COVID? Because I kind of, what is this title of this webinar is, what is the impact of COVID? And I think COVID pretty much killed Fridays for Future on the spot. What is your view? Here in Germany, it became very silent very quickly, but we're not really sure, and we are in an early stage of forming a view on how this might reappear, and if this will be really a dominant theme. Do you have a view on that? Maybe to the LPs, Aoifinn, when you speak with LPs, has that theme disappeared, or is it still a hot topic within the LP community that will reappear right after COVID is through?
I mean, that is, to me, what, you know, I'm trying with my clients who are LPs, I try to coach them, you know, around long-term strategic moves or changes we're making in a portfolio versus short-term tactical moves. And generally, I think very few of us are capable of making any tactical move that is timed correctly. So we generally shy away from those. But I would say that the climate change and responsible investing trend is a long-term strategic part of a portfolio. And that remains. Most institutional clients are not meeting besides meeting quarterly. They don't have an opportunity to turn on a dime, so to speak. So they are definitely still maintaining that at the forefront. If we look at the discussions, I mean, there's been a lot of the seeking silver linings from this crisis, and, you know, a lot of discussion of how, well, you know, pollution levels are lower, and, you know, there's in Milan, they're looking at opening up 32 miles of streets to bicycles, etc. So there will be changes that come about because of this. And I think importantly also the ESG aspect may not be directly related to climate, but the S aspect, the social aspect. I spoke before about corporate citizenship and how private equity companies, portfolio companies, or companies at large, the kind of citizens they are and how they behave now will, I think, be remembered. So, you know, we see it as actually quite compatible with whatever disruption this will cause, that ESG continues to be an important part of the conversation.
Thank you very much. And we are coming to the end of the webinar, and we still have over 100 people here. So I don't want to be rude, but I do not want to take too much of your time. So maybe you go into the chat section if there is still a strong interest by the participants here to ask more questions, or if we shall end here. Maybe you give me a quick response in the chat section if we can expect more questions. No, I think we have covered most of the questions, and there have not been any more. So I want to thank the panelists and the participants and viewers of this webcast very much for joining, for taking so much of your time to discuss with us, to listen to our discussion. Thank you to the organizers of the conference, Joseph, and your team. Thank you for putting that together and making this technical miracle work. Thank you to Prequin for sharing that data and giving us data points to reference in our discussion. And yeah, thanks to everyone. My name is Robert Spittler. I'm from the Silverfern Group, running the Frankfurt office. We are an opportunistic private equity investor. We originate and invest opportunistically alongside local investors on a global basis. And we look very much forward meeting you after this webinar. Please contact us via LinkedIn. Our contacts are shared in the communication you receive around this webinar and post this webinar. Please feel free to send us a message over LinkedIn, an email, or leave a message here in the comment section below, and so we can follow up with you. Thank you very much, and
yeah, thank you, Robert. And I would also like to thank all the panelists for their valuable contributions. I would also like to thank all the viewers who lasted with us this long. We hope you all enjoyed the webinar, and we hope to see you again soon. So until then, stay all safe and hope to see you next time.
Thank you.
Okay. Bye, guys.
Bye-bye.
Thank you.